And a very good Wednesday morning to you, live from London. This is Bloomberg Daybreak Europe. I'm Chad Thomas, and here are your top stories. The tech sell-off deepens, chip makers leading Asian stocks lower as global long-end bond yields hold at multi-decade highs. Oil climbs for a fourth straight day as President Trump hardens his stance on Iran, insisting no talks are taking place with Tehran. And President Trump delays new Canada tariffs just hours before they were due to come into effect, saying the two sides have reached a tentative deal. Now let's take a look at what's happening in the markets this morning. Asian stocks dropping with that semiconductor sell-off. This morning's decline being led by South Korean shares with chip bellwethers Samsung and SK Hynix both falling. Europe futures essentially flat. Europe, of course, not quite as exposed to the AI trade. And in the U.S., NASDAQ futures down slightly as we watch whether that tech sell-off continues there. We'll also be looking closely this morning at the FOMC minutes when they come a bit later on in the day. Let's take a look now at the cross-asset picture. Oil rising for a fourth day with no sign of progress toward a resolution between the U.S. and Iran after almost 6 months of conflict. Brent climbing this morning toward $92 a barrel. Treasury study at this hour following that global bond sell-off we've been following all this week that has pushed 30-year yields to levels we haven't seen since the financial crisis. And the Canadian dollar up this morning against its U.S. counterpart, that after Trump delayed those 50% tariffs on Canadian products as they continue to negotiate. Now let's take a look at some of the key events we'll be following throughout the day. July inflation for the UK is due at 7 a.m. local time, with CPI seen ticking higher. At 10 a.m. UK, we'll get the final July inflation print for the euro area. And at 7 p.m. tonight, we'll be watching minutes from the Fed's most recent policy meeting. Lots to get to today. Let's get started. Tech leading stocks across Asia sharply lower this morning. Let's get a check on all the overnight action with Winnie Xu in Hong Kong. Winnie.
Yeah, good morning, Chad. We are seeing Asian stocks tracking those losses from its U.S. peers overnight. And it is really still that chip sell-off continuing amid the higher oil prices, plus the elevated yield environment, which is usually bad for tech stocks because of how these high valuations rely on the future earnings, plus some concerns when it comes to the rising borrowing costs weighing on the capex spending when it comes to these U.S. hyperscalers as well. Now you can see that tech is really leading declines today. MSCI Asia overall down about 2%, having its worst day in 3 weeks. Now, Kospi down about 5%, but also we are seeing tech-heavy gauges in Japan and Taiwan following those declines as well. Now, on the days when you're seeing weakness in these markets, that's usually when Hong Kong shares doing slightly better. As you flip the board and see how that's showing up today, we have HS Tech down slightly less than 1%, so doing slightly better, but the overall weakness is still being seen specifically in the internet names, and Baidu here down about 12% after the company released quite disappointing earnings, some concerns around the massive capex spending, plus a slowdown in its AI growth. Now, the bright spot, though, is in Unitree Robotics. The company just had its IPO earlier today in Shanghai, with shares jumping as much as 630% at the open after the company has raised about $900 million. Now, this is making this company the very first publicly traded humanoid robotics company in China. So it does have a very significant role when it comes to that AI race between China and the U.S. Now, flip the board, we also take a look at what's going on in the bonds market because it still is that big story today in global markets. Of course, we are seeing treasuries stabilizing a bit after the 10-year yield having reached that highest level in about 19 months. And you are seeing Asia bonds following those moves with Japan, Australia, and New Zealand all seeing yields falling back a bit. While when it comes to currency space, we are seeing the Japanese yen strengthening just a bit, moving away from that 160 level against the dollar, against a weaker greenback as well. Back to you, Chad.
Bloomberg's Winnie Xu in Hong Kong. Thank you, Winnie. Bonds are steadying this morning after that sell-off, which pushed long-end yields across the globe to multi-decade highs, with the U.S. 30-year yield hitting its highest since 2007, and peers across Europe also under pressure. Let's bring in Ven Ram, cross-asset strategist at Bloomberg M Live. Ven, what are the biggest drivers of this pressure we're continuing to see in the bond markets?
Morning, Chad. I think principally there are three big drivers. One of them is the AI-related capex spending, of course, which of course is the biggest catalyst at the moment. The second one is, higher deficits. The US hasn't tried to wean itself away meaningfully from the idea of higher deficits, and that is feeding through into the long end of the curve as a risk premium. And the third one is the inflation aspect of it, because, the US has missed its the Fed has missed its inflation target for the better part of 5 years now. So that is also, if you combine all those things together, what you get is a massive risk premium at the longer end of the curve. And that's what we have been seeing happening with the 10 and 30-year segment. Now, interestingly, Chad, a few years ago, any of these governments could have raised financing at pretty low rates, rock bottom rates, but gone are those rates. And what does that tell us? It tells us that, the neutral rate of interest has probably shifted higher. And that's the biggest takeaway here. The neutral rate represents the equilibrium between the supply of funds and the demand for funds. Now we have seen a demand for funds soaring because of the AI spending, and that is not being met with adequate supply, and that is the push that we are seeing higher in yields.
And then we've been reporting overnight that some bond traders are beginning to hedge the risk of a Fed rate cut next year. How will markets react to this changing central bank outlook?
Well, I think that's a tail risk. I mean, as you mentioned, it's a hedge that they are putting on, so which is very much a tail risk scenario. Given the economy that we are in, what would require the Fed to cut rates would be a scenario where the economy goes downhill, i.e. the jobs market sours a lot. And I don't see that happening just yet, but it is probably a prospect, which is why they're putting on the hedge trades. But if that happens, the sell-off in duration that we are seeing now will abate, and it will go in the reverse direction. We'll see a massive bid for 30 and 10-year bonds, but we are nowhere at that stage. And as I want to emphasize, that is the tail risk at the moment.
Ven Ram, Bloomberg MLive strategist. Thank you, Vem, for joining us this morning. Oil trading higher for a fourth day after President Trump insisted there are no ongoing talks with Iran. The standoff leaves the Strait of Hormuz in limbo, with traffic still a fraction of pre-war levels, as Washington prepares to ramp up economic pressure on Tehran. Bloomberg's Abir Abu Omar is in Dubai for us. Abir, with no talks underway, where does the U.S.-Iran conflict go from here?
Good morning, Chad. Well, I mean, when it comes to the talks themselves, it also depends on who you're talking to. President Trump says that there are no ongoing or planned talks with Iran. Jared Kushner, who's been a very active negotiator in this whole thing, says that some talks could be ongoing. They're active. As a matter of fact, he says that different areas of the Iranian government, conversations with those are ongoing. So there's a little bit of discrepancy in those statements as well. But then from the Iranian side, of course, you're seeing that the top negotiators there, the top negotiator, Ghalibaf, with the United States, had said that the reopening of the Strait of Hormuz and commencing any kind of negotiations with Americans is not going to happen unless the U.S. stops all military actions against Iran, lifts its naval blockade, unfreezes those assets, and then lifts the oil sanctions. Of course, the concessions that were reached in Switzerland in June, those that were rendered meaningless by both Iran and the United States. And so you're still seeing those back and forth remarks. And we're choosing to look at what is happening on the ground and the reality of what is happening on the ground. And even that does not paint a very positive picture, because until yesterday, you were still seeing attacks happening in the Strait of Hormuz. The UK Navy reporting a vessel that was hit, with one casualty reported there, and then some other vessels that were making erratic moves in the waterway before deciding to stop by the Qashm Island by Iran because of the threat that Iran still poses on those vessels that are trying to make their way through the waterway. And this is really why you're seeing Brent crude prices settle nicely above that $90 a barrel mark. So quite elevated, not as elevated as what we saw during the peak of this war, but still above what we were seeing in the past couple of weeks or so, Chad.
Well, in Abir, the UAE says 2 ballistic missiles were also fired towards it from Iran. What does this tell us about the wider situation in the Gulf region?
Yeah, so yesterday at around 7 p.m. or so, we received those missile threat alerts on our phones, and then the UAE government came out moments after and said that it was targeted by two ballistic missiles of Iran. Iran rejects that claim, of course, but the situation has been escalating in the region. The UAE hasn't had those alerts in quite a really long time. We saw, of course, other countries in the region getting hit. We saw ADNOC ships, those are the UAE's energy companies' vessels being attacked in the Strait of Hormuz about a weekend ago. And so those escalations have been happening in waterways in the Red Sea as well, but we haven't seen this level of threat in a while on the UAE, particularly. Of course, the UAE said through the foreign ministry that it's halting trade and financial pacts or trade and financial relationships with Iran until further notice, that it rejects and condemns those Iranian actions. And so what we know now for further negotiations to happen between the Gulf and Iran is perhaps what we heard from Jake Sullivan, of course, the former national security advisor under Joe Biden, who said something that is quite a consensus among some analysts, and that is that Gulf countries may need to eventually just have or broker their own kind of deals with Iran, regardless of that relationship that they have with the United States, just because this stalemate has been going on for quite a while, and it's really affecting the regional economies in the picture when it comes to those oil exports. And while, of course, higher energy prices are positive for these exporters, the lack of movement in the Strait of Hormuz and now what we're seeing in the Red Sea is going to ultimately be net negative on them. So a lot of unclarity still, Chad, but a situation to monitor over the next couple of days or so.
Bloomberg's Abir Abu Omar joining us from Dubai with the latest. Well, still ahead, UK July inflation data is out at 7 a.m. We'll discuss that and more with Freya Beamish, chief economist at GlobalData TS Lombard. But first, China's biggest humanoid robotic firm makes all the right moves, surging more than 600% at its Shanghai Open. That's next, and this is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Unitree Robotics shares opened 629% higher in its Shanghai trading debut this morning. More than $900 million was raised in the IPO, making it the first publicly traded humanoid robot maker in mainland China. Let's bring in our China correspondent, Minmin Lo in Hong Kong. Hey. Minmin, why was this such a successful IPO?
Yeah, a very successful one. I think it's come off the highs now, but it's still about 400% or so higher than the offer price. So huge interest in this stock because, of course, everybody wants to get a piece of the pie, right? This is the first pure play humanoid robotic stock to be publicly traded. And it is one of the most prominent companies in China, one of the market leaders. In fact, it was a market leader for a long time, but then last week it was overtaken by Edgybot, which is another Chinese company which had surpassed it in robot sales. But we're also at an inflection point when it comes to humanoid robotics. JP Morgan, for example, projecting that this year's global shipments could hit 60,000, and by 2030 that could go up to 1.7 million. So this is a close to 30-fold increase, and so that's why people just want to get in at the early phase of this growth cycle and to, of course, capture some of the returns there, given that this is one of the few profitable companies in the humanoid robotics sector.
And Minmin, how does Unitree plan to sustain its economic and product performance in the long term then?
Yeah, it's been investing on product development, on research, expanding its product capacity, and you saw some of the videos just now of the robots performing gymnastics, and it has one new robot called Superman that can jump as high as 2 meters. I'm not sure what you need a robot to do that for, but certainly we're seeing some of these leaps in the technology that has been quite eye-catching. But some of its vulnerabilities include the fact that it hasn't invested as much in its AI models. So to address that, it has partnered with DeepSeek, which is investing in Unitree for a 2.3% stake and will then offer DeepSeek to help power the embodied intelligence of these robots. It also has very strong sales. Last year was 5,500 humanoid robots that were sold by the company. But one of the vulnerabilities is that it's heavily reliant on the academic institutions as a key client. So that's also something the company has acknowledged, and they're looking to diversify that. And of course, another headwind is regulatory headwinds from the US, right after the Trump administration has banned these new models of humanoid and quadruped robots. That could be a headwind for Unitree, although analysts say that for this company, they will still have likely no problems expanding into other regions outside of the US.
And as we look sort of projecting out into the future, what do we see as the uses for these robots? What sort of areas do you think they'll be most likely to be used?
So a lot of humanoid robots I mentioned earlier has been sold to academic institutions. So a lot of it is research-based. When it comes to the quadruped, depending on how hardy it is, there are different grades of them, and Unitree produces some of the more competitive ones. But the hardier ones, they are able to go into industrial usage, even, for example, search and rescue, fire operations, going to check on power grid systems, navigating dangerous mines, for example, and of course, when it comes to consumer-facing sort of robots, a lot of these robots nowadays are being used as companion robots. They can even teach you, for example, to practice speaking Chinese, for example. So a lot of these Chinese humanoid robotics startups, they are experimenting with many new types of products. Some of them are assisting the elderly with mobility issues, for example, plenty of use cases. But of course, question is whether it will see the sort of mass scale usage that would be key for future monetization.
So fascinating, Min Min. I'm going to be looking for my invitation from you to come there and check them out myself with you in China. Bloomberg China correspondent Min Min Lo joining us this morning. Now, coming up, your pledges billions to build its tech autonomy, but analysts say it should be spending trillions. Those details are next, and this is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Brussels has pledged to spend 30 billion euros to build 7 AI gigafactories across Europe. But Bloomberg Intelligence data estimates the EU will need to spend at least $3 trillion by 2035 to be truly self-sufficient in technology. Well, joining us to talk about all of this is Chief Europe correspondent Oliver Crook. Ali, what does this path to AI and tech autonomy look like in Europe?
Yeah, so listen, Chad, I mean, we get all these sort of initiatives out of the European Union. It's not always clear what they mean, how much money is actually committed by various governments and these sorts of things. So that 30 billion figure is actually a much lower figure in terms of what the EU is going to pledge. It makes a lot of assumptions in terms of what private investment is. But Bloomberg Intelligence has very helpfully mapped out what a roadmap for actual tech autonomy in Europe would look like. And the bill for that, Chad, is going to be $3 trillion through 2035. And that is, of course, an absolutely huge sum of money. In terms of the priorities, number one on there, you can see it on your screen, cloud infrastructure investment, $1.5 trillion. This is an arena in which the Europeans are still very dependent on other countries, particularly the United States. There's going to be some investment in semi-cap equipment. That's more than $500 billion. This is an arena where there is some strength in Europe because, as you know, there is some investment in already capacity to build semiconductors, but mostly analog, things for EVs, things for sort of smart appliances, not so much the very advanced semiconductors for AI. And of course, another $500 billion will have to be spent on foundries, to say nothing of the large language models, which will require $300 billion worth of investment, and where the Europeans, as you can see on your screen right there, have a very, very small market share. Really, the only big player within that space is Mistral. The only place where the Europeans really are dominant, and this is in one particular sector thanks to one particular company, is the lithography machines, the machines that build the chips themselves, ASML. They basically completely dominate that market. But basically, Chad, if we look at $3 trillion investment, regulatory overhaul, all of these sorts of things, that will get Europe on the path, but that will not even get them full autonomy because of how far behind they are on technology.
Ali, how likely is it then that the EU and Europe can catch up on AI, given how far behind they are?
Yeah, so listen, this is the big question, I think, for European policymakers, and also how to sort of construct things in order to get things on track to catch up with the United States. I think there is a side of things that starts to think about the realisticness of such a goal. I mean, there's another piece of research out from BI which looks beyond just the technology sector, thinking about defense, thinking about energy, thinking about power grids, all of those sorts of things. That is going to cost $14 trillion through 2035. And as Europeans sort of face down the highest borrowing costs we've seen basically since the financial crisis, very stretched budgets fiscally, there's going to have to be a very difficult conversation in terms of budgetary triage, where you actually need to spend that money. And is AI and technology really going to be number one when you're dealing with trying to support the very large European welfare state? You've got to obviously spend a lot more on defense, and the technology is obviously absolutely critical, particularly when you look on what you're seeing at your screen there, when you look at the GDP gap between the United States and the European Union. You know, these were economies that were basically quite close to the same levels of productivity, quite close to the same levels of GDP, and you can see that gap on the screen basically blowing out, and that is going to continue to happen if the Europeans basically cannot catch up on technology.
Bloomberg's Oliver Crook joining us from Brussels this morning. Bloomberg, Ali, thank you so much for joining us. Now to some corporate news. Bloomberg understands that Anthropic's revolving credit facility is set to rise above its roughly $10 billion target as the company prepares to IPO. Meanwhile, the information reports that Anthropic is planning to give shares with extra voting power to its CEO, Dario Amodei, and other co-founders. OpenAI is tightening safeguards on its models after a breach involving Hugging Face raised fresh concerns about cybersecurity. The ChatGPT maker says it will step up monitoring of unreleased models, aiming to alert safety teams to concerning behavior within 30 minutes. The company is also restricting internet access for certain models and introducing stronger controls on higher risk tasks. Meta has been accused of deliberately designing Facebook and Instagram to turn children into compulsive users and boost advertising revenue. A lawyer for 29 U.S. states made the allegation at the start of a federal trial in California. Meta denies the claims and says the states are seeking unreasonable design changes and an outlandish payout. Well, let's take another look at the markets this morning. We can see that Asian markets down, dropping with that semiconductor sell-off. This morning's decline being led by South Korean shares with chip bellwether Samsung and SK Hynix both following. Europe futures also essentially flat. Europe, of course, not as exposed to the AI trade. We'll be watching, of course, the UK CPI data coming out at the top of the hour as well. And in the U.S., we have NASDAQ futures down slightly as we watch whether the tech sell-off continues there. We'll also be looking closely at the FOMC minutes later in the day. And we also have the big U.S. retailer Target reporting earnings, so we'll be watching to see what they have to say about the state of the U.S. consumer. Coming up, UK inflation data for July is widely expected to tick higher. We'll discuss the outlook with Freya Beamish, chief economist at GlobalData TS Lombard. That's next, and this is Bloomberg. And a good Wednesday morning to you, live from London. This is Bloomberg Daybreak Europe. I'm Chad Thomas, and here are your top stories. The tech sell-off deepens. Chip makers leading Asian stocks lower as global long and bond yields hold at multi-decade highs. Oil climbs for a fourth straight day as President Trump hardens his stance on Iran, insisting no talks are taking place with Tehran. And President Trump delays new Canada tariffs just hours before they were due to come into effect. saying the two sides have reached a tentative deal. Now let's take a look at what's happening in the markets this morning. Asian stocks dropping this morning with that semiconductor sell-off that we've been seeing. This morning's decline being led in particular by South Korean shares, with chip bellwethers Samsung and SK Hynix both falling. Europe futures flat this morning. Europe, of course, not quite as exposed to the AI trade. And in the U.S., NASDAQ futures down slightly as we watch whether that tech sell-off is going to continue there. We'll also be looking closely at the FOMC minutes coming later today. All right, let's take a look at the cross-asset picture now. Oil rising for a fourth day with no sign of progress toward a resolution between the U.S. and Iran after almost 6 months of conflict. Brent climbing this morning toward $92 a barrel. Treasury steady at this hour following that global bond sell-off that we've been following all week that has pushed 30-year yields to levels we haven't seen since the financial crisis. And the Canadian dollar up this morning against its U.S. counterpart. That after President Trump delayed those 50% tariffs on Canadian products for 3 days, saying the two sides have reached a tentative deal. Well, UK inflation data for July is out shortly and is expected to show a jump due to a rise in household energy bills. Let's get more on this now with Freya Beamish, Chief Economist at GlobalData, TS Lombard. Freya, thanks so much for joining us this morning. So what are we expecting from the CPI data that's coming out?
Yeah, so that sort of off-gem price cap has protected consumers from the worst of the Strait of Hormuz shock so far, but it is now shifting. So we're gradually seeing that lagged effect of energy coming through. I'm very much looking through that. I think actually even Bank of England research suggests that given how slack is appearing in the UK labour market, the second round effects of this shock are going to be less than markets have been seeing over the past kind of actually 10 years or so since we've had that continuous mismatch in demand and supply since Brexit in the UK labour market. The second round effects of these types of energy shocks have been quite big, but the labour market has now come back into balance and actually gone into slack. So this time around, it's more likely that we see inflation coming down quite quickly.
So do you think we should be looking today and in the future at core CPI as opposed to the wider gauge then?
Yeah, I think, prior to this kind of rise of negative supply shocks, which is a systemic feature of the new sort of global macro regime, central banking 101 was that you look through this type of a shock. But because there have been so many of them, a lot of central bankers, the way they think about how inflation gets formed, inflation expectations are worried. They're worried that will start to de-anchor. So these types of shocks are having more weight than they have done historically. But with the Bank of England, which is at the more hawkish end of the spectrum in that sense, when you actually look at the report, it sounds way more dovish, and it's just the headline that is coming through on the more hawkish side, completely focused on oil. In fact, Bailey was almost just reading out what oil prices had done at the beginning of the last meeting.
So if you're the BOE, what do you do at this point?
I mean, we don't expect them to hike this year. I think actually, one of our biggest causes is that probably the terminal rate for the Bank of England could be significantly lower than it is just now. And you almost have like the opposite situation playing out in the Bank of England versus the Fed. For the Bank of England, it's all about imported inflation. The labour market is slack. For the Fed, more of a question mark there in terms of actually is this domestic inflation that is starting to sort of to pick up, obviously not in the latest data, but on a trend basis.
We have oil back over $90 a barrel now. What does that mean for the inflation picture more broadly across Europe?
Yeah, I mean, it does translate more into Europe than it does in the US just because of the structure of the market here and the weightings in the basket. I'd say it's actually, so I have a sort of contrarian impression of this because I think as energy shocks come through, it destroys demand. And so it depends like where you are in the cycle as to how persistent that actually is. In Europe, there's a little bit less demand resilience than there is in the US. So for Europe, it probably washes through more quickly, whereas in the US, there's a little bit more kind of resilience there. And if anything, like second round effects would be bigger in the US.
We've seen these incredibly high bond yields in the U.S. and also now even if we look to Germany yesterday, for example. What is driving this from your point of view?
I think it's so many things. I think that there's so many sort of macroeconomic shifts. We call it the new global macro regime. So partly it is this greater likelihood of negative supply shocks. Negative supply shocks push up inflation, destroy demand, destroy the hedging properties of bonds for equities. And so investors should be asking for more to compensate them for the deterioration of those hedging qualities for bonds. But at the same, that's the sort of the negative reason around yields, why yields might be rising. At the same time, this is a re-leveraging cycle. You hear a lot about kind of crowding out. I think that's a very negative way of putting it. I think there's just good demand in the private sector and maybe a bit of fiscal profligacy across the world at the same time. And that's actually not a bad place for equities, at least in the short term, as long as the Fed keeps up with it.
Well, you're talking about the demand in the private sector. So is it essentially the AI build out and there's so much money that's flowing into that investors have choice? Do I buy a treasury or do I buy a bond being sold by a tech company?
Yeah, I mean, I think, there's a re-leveraging cycle when, most of us have been used to for like more than a decade, a deleveraging cycle. So that instantly is going to mean that there's more demand in the economy. I was speaking to John Greenwood recently about this, and he was pointing out that debt is about a re-leveraging cycle is about quantities, and the Fed is moving with respect to interest rates. And that's 25 basis points each time is never going to actually keep up with the pace of that expansion of quantity of debt. So we're in a re-leveraging cycle. That's not necessarily a bad thing. It probably means at some stage that the Fed is going to be behind the curve. That's not necessarily the case just yet. We're also in a cycle where wage growth is more likely. We've got a sort of a tightening of the labour market on a global basis. Even from China to across developed markets. So that's always going to put upwards pressure on kind of trend inflation. We've got a world that is more likely to have these negative supply shocks. Again, that is going to put upwards pressure on inflation and drive up term premium. And we've got a situation at the long end of the curve where it's much more likely that governments are going to be issuing onto hedge funds rather than real money investors that have more sort of stable supply. So you get more volatility at that long end of the curve. That then feeds back into the term premium because it makes it more difficult for hedge funds to clear the market.
So what can the Fed do here?
I think the Fed can just, get out of its inertia state, start hiking rates and sort of move the economy on from that.
Freya Beamish, thank you so much for joining us here on Bloomberg Daybreak Europe. Freya Beamish, Chief Economist at GlobalData TS Lombard. Well, Carlsberg is expected to post strong numbers at the top of the hour after the Danish brewer emerged as one of the big beneficiaries of the World Cup this summer. Let's bring in Sarah Charlene, Bloomberg's Copenhagen bureau chief. Sarah, what are the big questions hanging over Carlsberg going into these results?
Yeah, as you just mentioned, Chad, the World Cup is one of the things that we're definitely going to be looking for. Carlsberg has already been mentioned as one of the big winners from the tournament. They have really strong presence in some of the countries that did well in the World Cup: England, France, Switzerland. So that's some of the things we're going to be seeing if that really translated into stronger organic volume growth. There's also, we're looking for maybe there's some softness in the overall beer market. Analysts are saying that we could see overall trends being really soft for the second quarter. So it's a bit of like whether the World Cup can outweigh some of the structural headwinds.
And Sarah, talk to me a little bit about Carlsberg and China. Bad weather in China has been mentioned as a concern for them. How big of a problem could China be in the numbers today?
Yeah, like we've seen the bad weather in China prop up in basically all of the analyst loans we've been going through. China is a strategic market for Carlsberg. It's really incremental for them to build out their Asia strategy, and they've been struggling a bit in China. There's been weak consumer spending. Some of the customers have opted out of the more expensive beers and gone for some of the lower priced premium lower priced local brands. So we're going to see if Carlsberg is going to frame this as just really big, poor beer sales in China because of poor weather. This is like a structural problem in demand. And I think this is something that could really move the share price. We've seen from years ago that they said that beer sales in China could weaken, but they still keep it as one of their major strategic points.
Sarah, Carlsberg expanded its partnership with PepsiCo during the quarter. Are we expecting to hear more on that today?
It's certainly something that investors and analysts are hoping for, especially like here in Denmark in the Nordics. Carlsberg has traditionally partnered up with Coca-Cola, but they said they're going to change the partnership and move it on to Pepsi. Now we also see other geographies, recently Azerbaijan, where they're moving over to a Pepsi bottling partnership. I think the big question is, can they convince drinkers in these markets to switch to Pepsi instead of Coke? Because they're really, for the whole soft drink strategy, putting a lot of hopes on Pepsi. And with beer demand declining globally, not just here in Europe, Carlsberg is really putting a lot of hopes on its soft drink strategy. And that's also one of the things that investors and analysts are going to be looking for this second quarter. If we're going to see like a bigger sales in soft drink, can maybe outweigh some of the weaker trends that we're seeing in beer.
Sarah, thanks so much for joining us this morning. Sarah Charlene, Bloomberg's Copenhagen Bureau Chief, will be watching for those results coming out at the top of the hour. And don't miss our interview with the Carlsberg Group CEO, Jacob Arup Andersen. That's at 7 a.m. London time. Now coming up, a popular ex-minister has called for wartime elections in Ukraine. We'll have more on that next. And this is Bloomberg. Welcome back to Bloomberg Daybreak Europe. President Trump has delayed planned 50% tariffs on billions of dollars of Canadian products for 3 days. The last-minute reprieve came in a Truth Social post with Trump saying the two sides have reached a deal in principle. Bloomberg senior editor Derek Walbank reports.
Donald Trump delayed tariffs on billions of dollars of Canadian products. There were supposed to be 50% tariffs, and walking up to the very deadline, just hours to go, it was unknown on both sides whether or not this was going to take effect or if there was going to be a sudden reprieve. The answer in a Truth Social post, sudden reprieve. It's 3 days long, and in those 3 days, we need to come to a deal of some sort. Trump said, subject to the finalization of documents, was the exact way that he put it. We got a little bit of a different readout from Canadian Prime Minister Mark Carney. He wasn't quite as definitive. He said substantial progress has been made, although there is important work still to be done. Now, the trade dispute between the U.S. and Canada has ranged for quite a while, right? And it's a little bit difficult to say what all of this is kind of about sometimes. Canada has struggled to figure out exactly how to go back and forth with Trump. They've tried under Justin Trudeau to have sort of matching reciprocal tariffs, and they've tried under Mark Carney to take a little bit more of a conciliatory tone. They have been able to get some things done, but either which way they go, it does look like, time and again, things come forward and they get by there. So Canada's really trying to get to a point where it can sort of underline this and not have to do this all over again.
And that was Bloomberg senior editor Derek Walbank reporting for us. Now to some other top stories we're following this morning. Rising ocean temperatures could fuel more intense storms in Europe later this year. According to new research from World Weather Attribution, the Mediterranean is heating twice as fast as the global ocean average, with some waters more than 6 degrees Celsius above normal in June. Researchers say man-made global warming was the main driver of record high sea temperatures around parts of Europe in July. Well, Swiss voters are set to reject a proposal to strengthen the country's neutrality in next month's referendum, with the new poll showing 62% opposed. The initiative was sparked by Switzerland adopting EU sanctions against Russia. Moscow has urged voters to back the measure. And a popular former defense minister has called for Ukraine to find a way to hold elections during the war, strongly hinting at his own political ambitions. Mikhailo Fedorov questioned whether Russia should effectively be able to determine when Ukrainians can next choose their government. Ukrainian bonds have emerged as one of the standout trades in global debt markets, delivering huge returns for investors willing to take that risk. Let's get more now on from Seljuk Gökaluk, Bloomberg's emerging markets reporter. Thank you so much for joining us this morning. Tell us about this rally in Ukrainian bonds.
Yes, it's been a surprisingly good year for Ukraine's bonds this year. Sovereign dollar bonds have already returned 12% so far this year. This is even better than last year's full year returns, 10%. I mean, there are several factors supporting Ukraine. One of them is global risk sentiment. People are chasing yields from Venezuela to Ukraine. And there aren't many countries in Europe, in European indices or emerging market indices, that offer investors 12% or 13% yield like Ukraine. And at the same time, we have very strong European Union financial support for Ukraine. Many European countries see Ukraine as defending Europe against Russia, IMF help, and at the same time, recent restructuring. All these factors convince investors that Ukraine is a good bet for the long term.
And what do you think are the key factors then powering this confidence in Ukraine?
One of the things that we mentioned, a recent factor in the story is battlefield wins by Ukraine. Ukraine is deploying drone technology and is making, attacks deep inside Russian territory. This makes investors believe that a surrender or sudden collapse of Ukraine against Russian advances is now less likely. This kind of is going to push Russia come back to the table, negotiate, and then find a solution and end the war with Ukraine. This is kind of making bonds more attractive, cited by many investors.
And to what degree do you think bond investors are following sort of what's happening politically in Ukraine? How much do they care about that, the reshuffling that's been happening within the government, for example?
At the moment, if you look at the prices early this morning, there isn't a big reaction, to be honest. There isn't a big sell-off so far in bond prices, or also we do not see a big increase. The thing is that probably many of the factors like European financial support, Western support for Ukraine is unlikely to change because of the internal political developments. But we will see and get more details in the coming days.
Thank you so much for joining us. Bloomberg Seljuk Gökaluk joining us to talk about Ukraine. This morning he has a great piece out on the terminal. It's our priority feature for the day, and of course you can also read it on digital. Well, there's plenty more to come on Bloomberg this morning. We'll be looking at some of our favorite charts that have caught our eye. We'll be back after the break with that. This is Bloomberg.
You can't just think about traditional factors or sectors or regions or even asset classes, because that AI tentacle is absolutely everywhere now, and that's only going to get worse. And so really important to stress test portfolios for an AI factor.
And that was JP Morgan Asset Management's Gabriela Santos warning of AI concentration risk. And Gabriela is spot on with those comments, and we can illustrate that with our charts this morning. So let's take a look at our first chart. Our first chart shows us how the market is receptive, at least at this point, to that enormous volume of debt being issued by big tech companies to fund the AI build-out, with investors snapping up these issuance. And that's giving investors, of course, choice where to put their money into, and that's having an impact on treasuries. treasuries. So let's take a look at our second chart. If we turn to that, we can see that the U.S. interest payments on its bonds have shot up to a record $85 billion as the U.S. continues to issue, of course, huge amounts of debt. So the sheer volume of debt out there for investors to choose from is part of what is driving up yields. All right, let's take a look at our third chart this morning. That brings us to the Fed and whether they might be whether the hike might be starting to lose some steam. That's, of course, in part due to the weak economic data that we've been seeing out of the U.S. in the last week. If we look at the chart here, we can see that the likelihood of an increase at either the September or December meetings is now under 40%. So it's been, if we go back to July, you can see that bumped up there a little bit, and it's now been dropping down a fair bit in the last couple of weeks, down below 40%. Well, to access, search, and save all of the Bloomberg Terminal charts used on this show and across Bloomberg TV, Terminal subscribers can use the function CHRT TV Go. And let's take a look at some of the key events we'll be watching throughout the day. July inflation for the UK is due at 7 a.m. local time, with CPI seen ticking higher. At 10 a.m. UK, we'll get the final July inflation print for the euro area. And at 7 p.m. UK, we'll be watching, of course, very closely what's coming up from the Fed's FOMC meeting minutes, those policy meeting minutes coming up later on today. And of course, don't miss our interview that's coming up with the Carlsberg Group CEO, Jacob Arup-Andersen. That's coming up in just a few minutes' time from now. That's, of course, going to be on the opening trade with Guy, Tom, and Skylar. They'll also be looking, of course, at the UK inflation data that is coming out at the top of the hour as well. That's it for us here on Bloomberg Daybreak Europe. Have a very good, wonderful Wednesday, and this is Bloomberg.